Anybody here? Let me know if you're here in the comments. I think I'm live. Yeah, I should be live. Oh, 3 people here. Okay, yeah. There are 3 people here. How's everybody doing? I just did a video on Nano Dimensions. It was an interesting company. It was a long video. It was over 30 minutes. And there was something in the video. What? Can you just say something?
Today is 57-cent scoop day.
Okay.
At Silverman's.
Okay. Can I do?
Did you get ice cream?
Yeah. Can you just give me?
I'm not saying the second.
I know. Later. I'm just online on live stream.
Oh, why did you say that?
Yeah. Yeah, definitely later. Thanks. Somebody asked me to do a video on Nano Dimensions. They make 3D printers. They have what's it called? Their AI. They're an AI company, an AI play. The stock has done pretty poorly, like most of these NMDM. Unless you're but I did something interesting in a video that I thought about making a video on valuing acquisition, and I always wanted to make a video on that, and it kind of came up while I was reviewing, so I figured I'll do it on the live stream. Let me just show you the company. I mean, it's just getting murdered. Yeah, they did a reverse stock split. I knew they did a reverse stock split so it was at 90 at its peak with the reverse split, of course, and now it's down to like 270 or something. Good morning, New Zealand. What's up, Ivan? So it's just getting murdered, but it's done really well in the past week, ever since they came out with earnings, because they had their first profitable quarter. And I explained in the video why they had a profitable quarter. It's not because they're making money. It's just kind of a mark-to-market valuation on their investment portfolio. But anyways, so Arthur, what's up? This stock is trash. ABCD? You mean ABCL or ABCD? I never heard of ABCD. ABCL, you mean, right? AbCellera is not trash. Why do you think they're trash? Because the stock price is going down? They have a good business model. They generated almost 500 million of revenue in 2022. I wouldn't say that's trash. Nano Dimension, I do agree it's probably trash. They generated like $100 million in revenue ever historically, if you sum up all their history. I mean, they're not making anything. They haven't even generated 100. In the past 4 years, they generated 60 million in revenue. But anyways, okay. Well, thank you, JB. That's really nice of you. Let's do Mo, value Mo, and then I'm gonna go back to showing you how to value an acquisition. Because sometimes when you invest in a company or you're looking at a company and that company does acquisitions, lots of acquisitions, and it seems like a good thing when a company acquires another company, but just because you buy other companies doesn't mean you're growing your business or using the investors' money prudently. Just spending money doesn't mean it's good. It could be good, but sometimes it could lead to a lot of downfalls and it could ruin companies, like it almost did with AT&T. Let the teacher teach. We are the students. But I like healthy discussion. And that's the great thing about the market is we have our own opinions. But let's do Mo, since somebody paid for it, and that was really nice. Okay. The thing with cannabis, tobacco, and gambling stocks, the thing I don't like about them, and the reason I don't invest in them, is because they don't get as much action by the big institutions. The big banks don't generally buy those stocks as much as they would a tech company because of the negative sentiment. And that's not a reason to avoid a stock, but institutions move stock prices because institutions like a BlackRock or Goldman Sachs, they can buy 5% of a company, 10% of a company. They can drop $5 billion into a company. They move stocks. We don't move stocks. Even if we get together and there's a million of us, we don't really move stocks. It's really hard for. Wow, you don't see Cebu too often. That's interesting, Robert. Welcome. So annoying. Let's Cebu. I think I mentioned Cebu. Am I saying it right? Cebu? I think I mentioned that in a video. I can't remember why. It must have been like somebody at a factory in Cebu or something. You covered S Maxilinear. What do you think of their potential acquisition of Silicon? But yeah, I'm interested. I want to watch the video on Nano Dimensions, but I could break down an acquisition for you, understand how to kind of like value one and see if should I be investing in this company just because they're acquiring this other company. But it's usually economies of scale. That's the benefit of, that's the main benefit of acquisitions. Is because if you have, I mean, think of you have a small, like a dry cleaner. You own a dry cleaner, and somebody in the next town over owns a dry cleaner. Well, if you buy their dry cleaner, right, you probably don't need like 2 accountants because that one, like each of you has your own accountant, each of you has your own attorney, each of you has your own like maybe marketing person. You generally don't need 2 accountants. You just need one, right? Like that. So you could eliminate a lot of jobs. Like there's no, that's a good thing about combining companies. And also the obvious is that you 21. Now you could buy more in bulk and you could get a better deal too. 21, 20, 21, 22. This is a really easy stock to value. This is when a DCF kind of makes sense with a stock like this. A company with, I mean, look at the free cash flows. This is the past 4 years. This is 2020, no, 2019, 2020, 2021, 2022. So 2019, 7.6 billion, 8.2, 8.2, 8.1. Very consistent and positive numbers. It makes it a lot easier to predict the future. And these stocks generally trade at a discount. Just because it's valued at 61 doesn't mean it's going to get there. And the reason they trade at a discount is because people just aren't willing to invest in a tobacco company. As there's many more people who are willing to invest in a company like that makes cars, or a company that makes food, or a company that makes some type of technology. Just a larger population of people will invest in a car manufacturer than a tobacco manufacturer. So it does limit the number of people. So they generally trade at a discount. Just like if you invest in two identical companies, say two identical car manufacturers, and one's in the US and one's in Mexico. The one in Mexico trades at a huge discount for the country risk. So these are always great companies on paper, especially Mo, the largest tobacco company in the world. But you get that great dividend, so it's a good stock. I only buy stocks that went up minimum. I just wish I put all my money into Apple, right? Instead of, God, it's so high, 3 trillion. This is crazy. But let me do it. Just leave a comment so I know you're here. So I could do a raffle, and then I could do a DCF on big. I just had to close the shade. The glare, I couldn't see the screen. Blue Z Robert T. Okay. So this is something I kind of wanted to always. I wanted to make a video on acquisitions because it's an interesting topic. Joe, what's up? So if you're looking at, like, we're looking at a company's income statement, and a lot of investors look at revenue. Revenue is a great way to kind of track whether a company is doing well or not doing well, because you can't really manipulate revenue, right? So let's just say you were looking at 2021 versus 2022. And you see their revenue went up from 100 million to 130 million. So it looks good. Like that would be a positive thing. So you would be more likely to invest in a company that did this than a company that did this. It did 110 million, right? Obvious reasons. You see a growth 30%. We had a 10%. But you can buy revenue. how do you buy revenue? You could just acquire another company. Like you can just buy another company. Like this company on top, they could have spent $50 million and acquired a company. Say a company generated 30 million revenue a year. They could buy a company, and now they have their organic revenue. They're 100 million. They did it again in 2022. They're 100 million that they usually do, but the company they bought for 50 million generated 30 million revenue. So now it appears the company's doing really well, but they just bought revenue through an acquisition. So how do you know if the acquisition was a good acquisition or not? It's kind of hard, but let me give you a simple way to think about it. So let's say you had a small business and you acquired a company. Actually, let me backtrack. Let me show you how this came about. Because when I was doing the video on Nano Dimension, I don't know if anybody follows Nano Dimension, the 3D printing company. There's this activist investor, Murchison, who owns, I think, like 6% of the company, and they're trying to change the board up because they're upset that the stock is down 77% since the new CEO came on board 2 years ago, and they have a negative 400 million enterprise value. So they're trying to get they're trying to remove 4 directors of the company and appoint 2 from their company, Murchison. This is just an asset management company in Canada, Murchison. And when you own a lot of shares of a company, you can possibly make these decisions. So anyways, this is what triggered me to talk about in the video, which you'll see tomorrow, value on acquisition, because he said this is a letter from this investing company, Murchison, trying to sway other investors to vote with them. But they say, we believe that Mr. Stern, the CEO of Nano Dimension, we believe that Mr. Stern has used this string of acquisitions to mask underperformance of the company. So he's just buying other companies. So then every quarter, he says, we have a new record, we beat our revenue again this quarter. We beat it from last quarter. And if you don't acquire anybody, you grow organically from 10 million to 15 million to 30 million to 50 million just through marketing and running good business. That's great. But if you grow at these big jumps by acquiring companies, it's not as good. Organic growth is the best. That's why Apple is such a beast. It's all organic for Apple. They hardly do any acquisitions. They do lots of small acquisitions, but they never overpay. Okay, so anyways, how about a DCF on Dogecoin? I don't think you can do that. So the way to think about it is, say we had a company, just to keep it simple. Say we had a company and we wanted to expand. You can use the dry cleaner example. Me and you owned a dry cleaner, and we wanted to buy another dry cleaner in the next town. So they asked for $1 million, the dry cleaner. And say we do acquire the other dry cleaner, and their revenue is $200,000. So let's just pretend that was their revenue last year, and their cash flow, because they have expenses, of course, is $50,000. So how do you know if that's a good acquisition? Yeah, sure. Our business, our portfolio, we went from, say, say we have $300,000 of revenue on our own, just our dry cleaner. Now we have 2 dry cleaners. So now we have $500,000 of revenue. So our revenue went up a lot. But the reason our revenue went up a lot is because we spent $1 million to get this other dry cleaner that contributed $200,000 of revenue. The simple way to do it is kind of similar to the dividend discount model. Same formula. So the present value, to get a value in today's dollars, you take how much cash flow that business generates. So the $50,000. Then you have to apply a discount rate. So if it's a really risky investment, you might be like a 15% discount rate. If it's a low risk investment, maybe you'll be like at 9 or 10. 10's a pretty safe discount rate. And then you have to apply a growth factor, because it'll probably grow more than like the 200,000 of, or the 50,000 of cash flow. It's probably going to go up over time. It probably won't stay 50 forever. You have to, so kind of a conservative growth is 5%. So it grows 5% a year. But a way to calculate the value of the investment is you take the cash flow, the annual cash flow, over the discount rate minus the growth. So if this is what we, of course, no one can predict the future. They might do a lot worse than 50,000. Or you have to make assumptions on the growth too. Maybe you think the growth won't be as 5. Maybe you think it'll be 4%. Now the value in today's dollars is 833,000. So in this example, it didn't add value to our company. We shouldn't have done the acquisition. We should not have. Even though revenue went from 300K to 500K. Like if you looked at our income statement year over year, because remember our dry cleaner generated 300K of revenue. Now we have this other dry cleaner, and if it did 200K, so now our revenue went up a lot. So just by looking at the revenue doesn't tell you the whole picture of the company. And a lot of people just focus on revenue. There's a lot of other things involved. That's why sometimes companies can be growing revenue massively, but year after year they lose money. I mean, the goal of any company is to generate positive cash flow. So in this example, it would have been a bad investment. If we say the dry cleaner really needed to sell, he needed money, he wanted to retire or whatever it is, and we got him down to 500,000. In this example, then it's a good acquisition. Even though we're only getting $50,000, you can't look at it. You have to assume it's gonna grow over time. Or even if you're not sure it's gonna grow much, you can always be conservative and have a lower growth rate. Even if it's 2%, it still worked out in our favor. Is that clear? I always wanted to talk about this on a video, and I think that's one of the hard things about looking at companies is that you see these I can't think of a good company. Let's see if Altria. You just look at, and this isn't really growing much. It went from 20 billion to 20.7 billion. But sometimes a company's revenue can double from one year to next, and that's bad. And another company's their revenue could go down 10%, and that's really good. Because it's based on a lot of other things. like an example of revenue declining. Say revenue went from 100 million to 90 million, went down 10%. But if you found out they actually sold off part of their company and they sold it off for, like, they sold that part of the, like, one of their subsidiaries for like $500 million, but their revenue didn't really go down much, only went down 10 million. So now they have all this cash from the sale and of one of their companies that they can use to buy something else. Maybe they can grow their main business. I don't know. I hope that's not confusing. I think it's pretty clear, but I feel like when no one comments, it's confusing. But hopefully in a video, if you watch the video tomorrow, it'll be clear. But I didn't talk about it in this much detail in the video. I just did a real simple discount model. Is anybody else here? I guess I'll do the raffle. If you get picked twice, then you could choose. Is there anybody following Nano Dimension? It's really interesting. There's like a 4-way merger going on. Okay, so let's. So 4, 1, 5. Anybody like my new logo? I hired this on Upwork. I hired this marketing company to try to help me figure out ways to grow up. I don't know. We'll see. I wasted a lot of money on these companies. Yeah, HP is good for that. It's much better than Nano Dimension. They're the 3rd largest hardware company that's in the world. Well, in terms of market cap. So I even won the raffle. So if you want to pick a, yeah, how do you value currency? Most people don't trade currency to make money. When people trade currencies, it's usually to hedge. Like if you like if say you buy a lot of products from Europe. Say in Italy, you buy a lot of products from places in Italy, and you have it shipped to the U.S. and then you sell it in the U.S. Well, you have a lot of exposure to the euro, USD. So if the foreign currency, like the euro, falls out of favor for you, it could cost you a lot more money to buy those products, even if that company didn't raise the prices. Even if they kept prices flat, you might pay 20-30% more. So a lot of companies just hedge, so they just buy fixed rate contracts. So they pay a flat rate regardless of where the currency goes. But crypto people invest in to try to make money, but you can't really. It's hard to make money investing in currencies. but it's kind of like gambling. Cole, what's up? Thanks a lot. Ivan, you got the so yeah, so this Murchison, they really don't like, and it's funny, it's like they own so much of, they own a big chunk of the company. Why did they even buy into the company? I guess when they bought it initially, they liked the company. Now with the new CEO, they don't like the CEO, so they don't want to sell at a loss. But it's kind of like, let me see the, so yeah, so Nano is tomorrow, the video Nano. Today I did the 3 beer companies. The only 3 publicly traded beer or alcoholic beverage companies: Bud, which is Anheuser-Busch, but their main product is Budweiser, and then Tap, which is Molson Coors. That's the second largest alcohol company in the world, Molson Coors. I think that was from 2018, right? 2018, when Canadian company Molson merged with the American Coors company. So Molson Coors. Boston Beer is publicly traded, but it's much smaller than these 2 companies. That's like Sam Adams. That's their product. Where do you see 3D? Yeah, Canarchy. They acquired Canarchy, but they're losing money on that acquisition. I don't know if you saw the video. Thanks, and Cognito. Yeah, like their margins are terrible. Let me see. Monster Energy. It's kind of like if something works, why do they do something different? Like, it's always interesting that if it's not broke, why fix it? But I guess companies are always looking to expand and scale and grow. I don't know. I get confused so much sometimes. Like, I think I figured it out, and then I realize how little I know. Yeah, it's such a small amount of sales. Only 46 million of the 1.1 billion is their alcohol. I think Canarchy is the main one. They also have like hey Ashley, what's up? What's the other alcohol brands they have? The Beast Unleashed. There's a few others, but I guess Canarchy is the main one. But yeah, I mentioned this in my Monster video. Like, so this is their sales by category. This is just for the first quarter, 23, 22. So energy drinks is where most of the revenue is, 1.56 billion. Strategic brands That's just where they sell the concentrate, like the syrup, to manufacturing, to a bottling company. Pretty much how Coke makes money. Then you have alcohol brands, 46 million. But like Monster Energy, 1.56 billion of revenue, operating income 560 million. Great, profitable, good margins. Strategic brands is almost all margin because they don't do any manufacturing. 86 million revenue, 52 million of operating income. So it's like 60% operating margin. The energy drink is like probably 30% operating margin, which isn't bad. But alcohol brands, 46 million of revenue, but they have a operating loss of 7 million. So they lose 7 million. So like every time they sell like alcoholic beverage, they lose like a quarter. I mean, so it takes time. It's a small part of their business. So I guess eventually the idea is to be profitable. So maybe once they hit like 200 million of revenue, they'll be profitable. But yeah, but it's kind of like a losing part of their business. So I imagine they'll stay with it, and then if it doesn't become profitable in like 5-6 years, they'll just get rid of it. I guess it's kind of like Facebook with the metaverse. That was a big bust, right? They I don't think they scrapped the metaverse, but they dialed back on it. So they're not doing it nearly as much as they used to. But so, I mean, sometimes I don't think this is the case with them, but sometimes companies lose money. They lose money on purpose, like a lost leader. So I don't think this is the case, but with this example, but I'll just pretend it is. So this $46 million of revenue and that operating loss $7 million, they're willing to lose $7 million because it brings in more parents, more people, more adults to their brand, and then maybe their kids will buy some of their products. So sometimes companies have a lost leader where they're willing. It's kind of like aircraft manufacturers. Like they lose money on selling, airplanes. They make all the money from servicing it because you could service it for 20 years. Like you might lose $1 million by selling it, but you make $10 million over the next 20 years from servicing that plane. I have an entire pie in MT. It's a buy according to the model. Nice. So I thought Nano Dimension was really interesting. They're working on Stratasys. I think that it's like 3 companies are trying to acquire Stratasys. It's them. It's 3D Systems, ticker DDD, and something metal. I can't remember the name of it. They're all trying to acquire this company. But I don't even know I guess they're just another 3D printing company, Stratasys. manufacturer of 3D printers. Oh, they're Israeli also. Okay. I guess that makes sense because Nano Dimension is also an Israeli company. The company is incorporated in Israel. Engineers use Stratasys to model complex geometries and a wide range of polymer materials. Stratasys. After Stratasys, a desktop metal. That's the other company. Did it go through? Did Desktop acquire them? It's been a while, a few weeks. Some of the biggest names in 3D printing last week. Stratasys announced plans to merge with Desktop, and now another industry bigwig is getting in action. Yeah, 3D Systems. I don't know if anybody follows Nano Dimensions, but I think they're the least likely company to acquire Stratasys because I don't think they have enough money to. They're not offering as much money, and it doesn't seem like the combination of Stratasys and Nano is going to be as beneficial as like the combination of Desktop Metal and Stratasys. Is anybody following the that situation? Ashley. And Cognita. Okay, I guess I'll do another raffle because Ivan never replied. 11 Cole 4 Big N Ashley and Arthur. Yeah, Cole. Cole, any idea what stock you want me to do a DCF for? Anybody have any questions on the acquisition example? Dave, did you guys see the quiz today? I think the answer in the quiz is the most interesting part of the quiz. Granger. You do the quiz. It's because I did a price to book. Like, what is the price to book of this company? But in the explanation, I gave 1, 2, 4 equations on price to book, which all makes sense because price to book is market cap over equity. It's also stock price over book value per share. I mean, it's infinite. I come up with infinite calculations, but another way to calculate price to book, it's stock price times shares outstanding over assets minus liabilities. Another way, it's stock price over assets minus liabilities over shares outstanding. Or enterprise value plus cash minus debt over current assets. I did not see the quiz today, but I really... Yeah, if anybody has like a quiz for me, like a question and all the answers, email it. It's hard to come up with ideas. I kind of, something comes to me and then I write it. So, but I don't think I'll ever run out of, because you can always come up with something for the quiz. What's everybody doing for the 4th? Any, I think we're going to barbecue here and chat GPT. Granger. Granger. See Granger. What's their their revenue went from 11.5 billion to 15 billion. If that was all organic growth, it would be much better than if the growth was purely from acquisitions. My company does a lot of business with Granger. Really interesting. Your company or the company you work for? It's a good company, Granger. The company I work for, okay. $19 billion, that's a lot of revenue. It's an art, not a science, these valuations. I mean, I'm trying to think of, it seems overvalued in most scenarios. My old employer did a lot of business with Granger too. Interesting. What kind of companies did you work for? Yeah, it seems overvalued, but let's see. Wow, it's up a lot. Yeah, I'm around the 500 mark in my valuation. So if I maybe 600. But if I did this video a year ago, it would have been trading at the appropriate level. It's really gone up a lot. Wow. So it's like there's so many stocks. It's like I would have never If you asked me about Granger, I would never thought it's trading at its all-time high. Oh, it's not. Oh no, it is. It is. It's really gone up a lot. Sheesh. Look at this. It's been around a long time. Granger sells everything from high-end test equipment to toilet paper. Yeah, but I think they're more focused on the high-end equipment, not as much as on those cheaper products. Yeah, I mean, they do have more of a specialty than like certain products anybody can make. But like when you get into like electronics or hardware, it takes, special know-how, machinery, things like that. It does create a little higher barrier to entry. It's like anybody can sell like a grocery store. Anybody can I mean, if you have the money, of course, you can open up a grocery store, like a little shop that sells snacks and stuff. Anybody can do that. If you have, a couple $100,000, but not anybody can do what Costco does, because that's just to scale it to that level. I mean, they don't do anything that special, Costco. It's not like they have this special formula that you can't replicate. Anybody can like buy stuff and sell it, and like, but they've gotten like this so many locations, so they can buy in bulk, and a great brand name, 50 plus years. But like if you look at another business like a Boeing, like we can't just manufacture airplanes. There's a huge barrier to entry. Even on a small level, we couldn't manufacture airplanes. It would take an enormous amount of money, like 10, 20, $30 million just to get your infrastructure built, and not to mention you need a lot of knowledge. But like anybody can sell stuff. Anybody can do what Amazon does on a small level. Anybody can sell stuff online, but to grow it to like a mass scale. So it's just something to think about when you invest in companies. That's why a company like this, it's a little more specialized. Like you just can't do it. What's going on with NNDM? How do they have that many assets? Why do you say that? Why do you say they have that many assets? They don't have many assets. You mean on a balance sheet? Why do they have $1 billion of assets? Is that what you mean? And they have cash on a balance sheet, but they don't really have that much else besides cash. Well, they have a lot of, they just raised a lot of money. They went public and they raised a lot of capital. They sold shares in their business, but they don't have anything special. Of the 1.2 billion of assets, I mean, pretty much all of it is cash. They have 400 million of cash, 570 million of bank deposits, which is cash, 160 million of investments. So it's just really cash. I mean, if you look on like Tesla's balance sheet, they have, tons of factories and equipment, like important stuff to make products and generate profit. It's good to have cash. Cash is helpful, but they don't have really much to show for it. They don't have any debt. They're losing money. So they shouldn't really take on debt. They had 15 million of revenue in the first quarter, which was their most ever, 15 million, which is nothing. So they're not really generating revenue. I mean, 15 million is great if we had a business with 15 million of revenue, but when you have a business with $1 billion of cash on your balance sheet, it's really they're not generating much revenue at this point, and they're obviously still losing a good amount of money. They burned 28 million of cash flow this quarter. Last quarter, 22 million of cash flow. I mean, really, the thing is, can they acquire a company, or can they build a great product? I don't see. I don't see the value in this company. It's a gamble. I don't see much. And they're not offering much, right? Like it's not. They didn't do anything. All they did was raise $1 billion of cash. That's all they did so far. So let's see what they do with that cash. Cintas. But the market's been doing well. I have a lot of Facebook. So I'm up quite a bit in the past year. I mean, I was down quite a bit in my Facebook. I think the first thing you should do when you look at a company is try to figure out how they generate revenue. You'd be surprised. Like, if I asked you, how does Coca-Cola generate revenue? I bet you 99% of the people I ask will not know how they generate revenue. You probably think they sell Coca-Cola, which they don't. I mean, hardly any revenue is from the sale of Coca-Cola. Pepsi, that's how they make money. They sell Pepsi. Coca-Cola doesn't sell Coca-Cola. Does that make sense? Is anybody with me? If you saw my Coke video, that's why they're such a cash cow. Like they're so profitable, because they don't really manufacture anything. They just sell the concentrate. They just sell a box of formula to these bottling companies. That's like 60-70% of their revenue. They just sell like the mixture, and then those companies manufacture it, which, it's not easy to build manufacturing facilities to manufacture products, and then they sell it to supermarkets and restaurants and hotels, and the billion people who consume Coke every day. I mean, if you want exposure to a company that makes Coca-Cola products, invest in Coke, COKE. They're a bottling company. This is not Coca-Cola. I mean, it's called Coca-Cola Consolidated, but they actually bottle Coca-Cola and sell it. But they sell other things. You know, they may sell Pepsi too, Coca-Cola Consolidated, because they're not Coke. They're the largest bottling arm for Coca-Cola. So, I mean, there's nothing wrong if you didn't know that, because a lot of people wouldn't know that one of the largest companies out there doesn't sell its own product. So that's why it's just interesting when you look at a company. I think you should look and figure out how they make money, because if you don't know how they make money, it's hard to do due diligence if you don't know that, because I think that's kind of like the cornerstone of a business, is how they make money, how they generate revenue. You know, and some companies have their expenses are higher than their revenue, so they're losing money, which is a lot of companies, especially in early years. But it's a great business model. I mean, it's genius, because it's a headache. That's why, like a Tesla, like car manufacturing companies just don't generally make a lot of money. It's expensive. It's hard to make cars. They're not small. It's expensive to ship it. There's tons of expenses. I mean, look at Tesla's income statement, and they sell a premium product. They're not like a Ford. I mean, 25 billion of revenue, and they still had a loss. 31 billion of revenue, and they had a small gain of 600 million. I mean, it's like, what is that, like less than 1% of their revenue? I mean, what is it? 31 billion over 690 million. $31 billion. Oh, 2%. So they managed to convert in 2020 31 billion, and they converted 2% of that to profit. And they're growing. I mean, huge, 50 billion. So they converted 10% to profit. But now they're at a point where they're generating healthy profits, and they're an investable company. Even at this level, 50 billion, they're still probably in a hole, like so much money from prior years. But that's because, like, what if they never got past 30 billion? It's still 30 billion is a ton of revenue for any company. I mean, it's hard. It's hard to hit hundreds of billions of dollars of revenue. So they may have never been profitable. Fortunately, they are scaling and growing. But I think tax credits have a lot to do. You know, that's helpful. Their tax credits. Okay. Yeah. Okay. If anybody else wants to donate for DCF, if not, I guess I'll just get off. Yeah. Okay. So thanks for joining. Try to watch Nano Dimensions video. It's a pretty long video. A lot going on. And I'll talk to you guys soon. Thanks a lot. Okay. Bye.